Nigeria recorded a current account surplus of $3.4 billion in the third quarter of 2025, supported by stronger crude oil and refined petroleum exports, according to the latest balance of payment data released by the Central Bank of Nigeria. A very warm welcome to you and Happy New Year. Welcome to Business, where we extract the Nigerian economy the policies. I am Kike Lomo Okere. Although the surplus remained positive, it represented a sharp decline of 41.14% compared with $5.81 billion recorded in the second quarter of the year, and was also lower than $5.78 billion posted in the corresponding period of 2024. The data shows that crude oil export earning rose from $7.66 billion in the second quarter to $8.45 billion in the third quarter of 2025, reflecting improved crude evacuation, fewer production disruption, and relatively stable international oil price. More significantly, exports of refined petroleum products surged by 44.03%, increasing from $1.59 billion in the second quarter to $2.29 billion in the third quarter. The growth was attributed to rising domestic refining capacity, including increased output from newly operational and rehabilitated refineries. At the same time, imports of the refined petroleum products declined by 12.7%, falling from $1.89 billion to $1.65 billion, easing pressure on the trade balance and reinforcing the positive impact of local refining on external accounts. Despite these oil sector gains, the overall current account surplus narrowed, reflecting higher overflows in services and primary income accounts, increased external obligations, exchange rate adjustments, and rising import demand outside the petroleum sector. The report also shows that Nigeria maintained a strong surplus in the secondary income account, estimated at $5.50 billion, largely driven by diaspora remittance, which helped cushion weaknesses in other components of the current account. The contrasting trend between quarters underscores that while oil exports improved in the third quarter, broader structural pressure continued to weigh on Nigerian balance of payments, particularly in the second quarter of the year, when import demand typically rises. Nigeria's external position has remained under close scrutiny in 2025 amid foreign exchange reforms, the full removal of fuel subsidy, and efforts to boost non-oil exports and reduce import dependence. An analysis shows that the surge in refined petroleum exports and the drop in fuel import marks a significant shift in Nigeria's trade dynamics and validates ongoing investment in domestic refinery. However, sharp quarter-on-quarter decline in the current account surplus highlights underlying vulnerabilities. Sustaining external stability will require not only stronger oil export, but also tighter import control, expanded non-oil exports, and consistent remittance inflow to buffer against external shocks. Nigeria external reserves are projected to rise to about $51.04 billion in 2026, up from estimated $45 billion in 2025, as easing pressure in the foreign exchange markets, higher oil earning, and increased capital inflow strengthen the country's external buffers. The projection is contained in the Central Bank of Nigeria Macroeconomic Outlook for Nigeria 2026, titled Consolidating Macroeconomic Stability Amid Global Uncertainty. The forecast comes as Nigeria external reserve continues to trend upward. As of December 29, 2025, reserves stood at approximately $45.45 billion, supported by steady inflow and improve market confidence. According to the CBN, the expected increase in the reserve will be driven by reduced strain in the foreign exchange market, higher crude oil export receipts, sovereign bond issuance, and stronger diaspora remittance inflow. The Apex Bank also identify rising domestic refining capacity as a key medium-term support factor, noting that the expansion of the Dangote refinery to 700 billion barrel per day in 2026, with plans to reach 1.4 million barrel per day in the medium term, would significantly reduce foreign exchange demand for fuel imports. The central bank says ongoing foreign exchange reform are expected to deepen market efficiency and transparency, narrow the gap between official and parallel market rates, and support exchange rate stability. This improvement, combined with lower import dependence for refined petroleum products, are expected to strengthen reserve accretion over time. On inflation, the CBN projects headline inflation to ease further to 12.94% in 2026 and decline to 10.75% in 2027, extending the disinflation trend observed in the recent months. Data from the National Bureau of Statistics shows that inflation has moderated consistently, with headline inflation falling to 14.45% in November 2025 from 16.05% in October 2025, largely reflecting base year effect and easing price pressure. While the consumer price index rose month on month in November, the central bank expects inflation to continue decelerating, supported by improved stability in foreign exchange and energy market. The lagged effect of the earlier monetary tightening, increased food supply from agricultural focused policies, improved security in food producing region, and favorable weather condition, increased competition in the downstream oil sector is also expected to moderate premium motor spirits prices. The CBN noted that the monetary policy in 2026 will remain flexible, balancing price stability with growth consideration. Policy tools such as the monetary policy rate, cash reserve ratio, and liquidity management instruments will be adjusted as needed to manage money supply growth and maintain an accelerating inflation path. Overall, monetary conditions are expected to relatively accommodate, reflecting reduced inflationary and exchange rate risk. On the fiscal side, the outlook for the 2026 is described as broadly positive, supported by anticipated improvement in crude oil production and the phased implementation of the Nigerian Tax Act 2025, which is expected to strengthen non-oil revenue mobilization. However, the CBN warns that downside risks remain, including the possibility of global oil price falling below budget benchmark production, shortfalls, elevated debt service costs, and potential pre-election spending pressure that could constrain fiscal space. The bank also flagged structural risk to revenue projection, noting that weak tax compliance, low awareness, and gap in tax administration could undermine expected gains from tax reform if not adequately addressed. In the financial sector, the CBN raised concern about rising non-performing loans and their potential impact on banks' balance sheet, while recent improvement in the capital adequacy and liquidity ratio provide some buffers. The central bank cautioned that these indicators remain vulnerable to macroeconomic shocks, foreign exchange liquidity pressure, and rising credit losses, which could weaken financial intermediation and strain market confidence. An analysis about the projection shows that the CBN projection of the higher external reserve signals growing confidence in Nigeria's macroeconomic trajectory, driven by foreign exchange reform, improved oil sector performance, and rising domestic refining capacity. However, the outlook remains fragile. Sustaining reserve growth and disinflation will depend on stable oil price, disciplined fiscal management, successful tax reform, and proactive measures to contain financial sector risk, particularly rising non-performing loans. The Nigerian National Petroleum Company Limited recorded a profit after tax of 502 billion naira in November 2025, extending its profitability streak despite ongoing challenges in the crude oil and condensate production. The strong earning performance came as a state-owned energy firm adjusted to intensifying competition in the downstream petroleum market by cutting the pump price of the premium spirit to below 800 naira per liter across several locations nationwide. According to the figure from the NNPC monthly financial and operation report for November 2025, the company generated total revenue of 4.36 trillion naira during the month, representing a marginal improvement over October. The performance was supported by stronger gas output, improved pipeline availability, and steady domestic fuel supply, which helped offset weaker crude oil production. Crude oil and condensate production averaged 1.36 million barrels per day in November, slightly higher than the 1.3 million barrels per day recorded in October. This marked the first rebound after 3 consecutive months of decline between August and October, although outputs remained well below the year peak of 1.77 million barrels per day achieved earlier in 2025. Gas production remained relatively stable and continued to play a critical role in sustaining operational performance. Output stood at 6,968 million standard cubic feet per day in November, broadly in line with October 6,997 million standard cubic feet per day. This resilience underscores the growing importance of gas in stabilizing earnings amid crude-related disruption. The November profit represented a slight improvement on October results, consolidating the company's earning momentum in the second half of the year. Revenue was driven largely by gas sales, trading activities, and improved infrastructure uptime. Between January and October 2025, statutory payment to the Federation account rose to 12.12 trillion naira, highlighting NNPC expanding fiscal contribution at a time of heightened pressure on public finance. While crude production shows signs of recovery in November, outputs remain constrained by operational setbacks. Repairs on the Vocados export lines, force majeure as the Egbama asset, and delay in achieving first oil from West African exploration project continue to weigh on overall production. Average output in November remained below the first half average of over 1.40 million barrels per day recorded between January and July. Despite this constraint, upstream pipeline availability reached 100% during the month, helping to stabilize evacuation and limit further production losses. On the downstream front, NNPC responded to shifting market dynamics by cutting petrol price by 800 naira per litre to remain competitive amid an intensifying price war triggered by increased domestic refining capacity. The entry of large-scale local refinery has reshaped pricing dynamics, forcing import-dependent marketers to adjust price to retain markets by mid-November. In NNPC filling station, we're selling petroleum at price above 850 naira per litre, but mounting competition from cheaper alternative led to successive price reduction. By late November, several NNPC retail outlets, particularly along major corridors such as Lagos-Ibadan Expressway, were selling petrol at around 785 naira per litre. NNPC was among the largest petrol importers during the month, building inventory to guarantee supply during peak demand. However, with import landing cost estimated at 828 naira per litre, competing the cheaper local refined products proved challenging, forcing some marketers to sell below cost. The deregulated downstream market has intensified price competition, with filling station adjusting price based on proximity to cheaper outlets. As a result, queues that once formed at NNPC station due to price differential have largely disappeared. With consumers' choice increasingly driven by price, gas performance continued to provide a stabilizing anchor for company. Gas sales reported on a 2-month lag stood at 4,650 million metric ton per day in November, slightly lower than October but significantly higher than September level. This reinforced NNPC's strategic push towards gas monetization as Nigeria positioned itself as a regional gas hub and transitioned to a lower carbon energy mix. The report also highlighted progress on critical gas infrastructure projects. The Ajaokuta-Kaduna gas pipeline achieved completion of mainline welding and pressure testing and remain on track for delivery in 2026. Work also progressed in Obiafu-Obrukum-Obem gas pipeline, which geotechnical study completed at the River Niger crossing and nearly construction activities on the way. NNPC says it continues to work with joint ventures and production sharing partners to complete turnaround maintenance and position assets for stronger output in 2026. All right, let's take a quick short break now. We'll be right back. Don't go away, stay with us. Welcome back. If you're just joining us, it's Business Point, where we extract the Nigerian economy and the government policies. The Naira closed the final trading session of 2025 on a firmer note at the foreign official exchange market, reflecting improved liquidity condition and stronger market confidence towards year-end. Data from the Central Bank of Nigeria shows that local currencies settled at 1,435 naira per US dollar on Wednesday, appreciating 9.93 naira compared with the previous session. This followed Tuesday's closing rate of 1,445.68 naira, representing a day-on-day gain of about 0.7%. The year-end appreciation capped a period of relative stability in the foreign exchange market, supported by seasonal inflow, tighter market discipline, and ongoing reform aimed at improving transparency and price discovery in the official window market. Participants attributed the firmer close to improved dollar supply during the festive period as exports proceed, remittance and year-end portfolio adjustment boosted liquidity. The reduced pressure on demand also helped limit volatility in the final days of the trading. Analysts say the sustained gains through the holiday season helped anchor expectations, setting a cautious positive tone to early trading in 2026. However, they noted that sentiment remains sensitive to external conditions, oil price movement, and the pace of foreign exchange inflow in the new year. An analysis shows that the Naira's stronger close at the official market reflect the combined impact of seasonal inflow and the ongoing exchange reform, while the year-end performance has improved confidence, sustaining currency stability in 2026, while depend on consistent inflow, disciplined demand management, and broader macroeconomic stability. All right, before we call it a wrap, let's take a quick look at the stock market. The Nigerian Exchange Limited closed 2025 on a strong note, recording a year-to-date market capitalization gain at 36.46 trillion naira, as sustained investors' confidence and renewed appetite for equities lifted valuation across key sectors of the market. Trading at the start of the year on Thursday, January 1, 2025, opened with 180.14 points. The market recorded steady gains in the first 2 months of the year, with capitalization rising to 67.19 trillion naira and all-share index advancing to 107,821.39 points by the end of February, highlighting early momentum driven by positive sentiment and portfolio rebalancing. By the close of the latest trading session, market capitalization had climbed to 99.2 trillion naira, reflecting stronger appreciation across banking, energy, industrial, and consumer stock. The market performance underscores the resilience of the Nigerian equity amid microeconomic adjustments, foreign exchange reform, and easing inflationary pressure towards the year end. All right, this is where we'll call it a wrap on Business Point today. Join me again tomorrow on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using @GlobalTVNG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.